We start 2025 in a similar fashion to the way we closed out 2024, and the next two episodes of Investor Insights will continue to take a small departure from the normal format of episodes in the series, which usually features portfolio managers. Instead, we invite a range of market strategists and economists from across the asset management sector in for discussion. Whilst we don't try and participate in the somewhat futile exercise of trying to predict what market levels will reach over the short term, the turn of the year is an opportune time to take a step back and summarise the current economic backdrop, try to assess what consensus looks like across market participants, and look forward to the calendar of events for the coming year and how various scenarios could impact various asset classes moving forward. Episode 43 of the series features Arun Sai from Pictet Asset Management. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co.'s Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co. is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killick.com. In this week's episode, which we recorded just before the Christmas break, we had a conversation with Arun Sai, who joined Pictet Asset Management in 2020 as a senior multi-asset strategist at the firm. He's tasked with devising actionable, practical and thematic investment ideas for the company. Before joining Pictet, Arun worked at Credit Suisse, where he provided country and sector investment recommendations and also authored several thematic research papers as a global emerging market strategist. As always, please do get in touch using the podcast email address if you have any questions or would like any further information on any of the topics discussed in this episode. Arun, good morning. Thank you so much for joining us today. How are you doing?
Morning, Gordon. Thank you very much for having me. I'm doing great, in fact.
Good stuff. So we've got this standard opening question, which we've asked all our guests all through the year, actually, and it's a question which kind of tries to get a bit of an insight into you and kind of how you go about your work. And recording this kind of just before Christmas, I wondered if there was an anecdote from a recent meeting or a meeting that you've had this year, or a research project, or even just a kind of book or article that you've read this year. Anything that you could share just to give us a bit of an insight into you.
Right. That's an interesting question. Let me recount an incident from earlier this year. So I attended a macro dinner in late August. There are 15 macro PMs and strategists. We had a little over 3 hours of lively debate, and China did not come up once. So a 3-hour macro discussion without China coming up. And this was at a point when we were mulling over when to close our underweight position on China, but could not find a catalyst. So I went back to my desk the next day and saw China was trading on an 8 times multiple versus India on 25 times, at which point we thought we had to make a push to close our China underweight and add to the market in some of our funds at least. And 2 weeks from then, of course, we had the news on stimulus, and in hindsight, we got lucky with the timing. But for me, this is a reminder that sometimes we can get too wedded to our models and our processes, and we don't feel comfortable taking measured leaps of faith. So that's something I think back to, because we usually have a 4-stage investment process, but this time it was on the back of a meeting and looking at a PE chart, and that turned out to be one of our better calls for the year.
Yeah, no, fascinating. Yeah, so it's funny how some of those decisions often come at the point where it's most uncomfortable to make those decisions. And I'm sure we'll come back to China and some of this dispersion that you between different parts of the market. I'm sure as we go through this. I mean, what we've been doing with these kind of more macro or kind of market strategy calls is to split the conversation up into kind of three main areas, I guess. The first one being kind of trying to tackle the kind of economic backdrop. We'll maybe go through certain markets there, then look at the kind of market implications for equities and fixed income and credit, and then maybe if there's time at the end, we'll have some kind of quick fire questions to go through, some other bits and pieces like the risks and things to look out for next year. So, but perhaps if I may, can I maybe start with the economic backdrop, and I guess you kind of have to start with the US just because it's the biggest part of things, and it's where all the kind of macro news, I guess, is coming from at the moment.
Right.
I wondered if I could ask you to kind of summarize your kind of key considerations. I was reading through your team's kind of outlet commentary, and you're kind of going
Yeah.
through the various implications of different Republican policy outcomes. Like,
Yeah.
could you summarize for our listeners that?
No, absolutely. But before we talk about Trump, I think it's important to kind of recognize that presidential cycles very rarely leave a lasting imprint on economic cycles, right? With that context, I think it's important we start with the big picture. Where do we see the U.S. economy heading, irrespective of Trump's policies? And here it's one of a normalization of growth, U.S. growth, especially in areas which have been very strong, such as consumers, such as services in particular, normalizes towards trend. So we see some softness there, but offset by a bit of a pickup in other areas, a little bit of a manufacturing recovery, decent capex, rate sensitive doing relatively better. So more of a normalization of growth rather than anything more sinister. Disinflation, we think, would still be pretty much on track, but it's not going to be one directional. As been seen from the last few months, we've had a little bit of a stalling in the momentum of disinflation, but we think by and large we are on track. So that's the base case, right? Then you introduce Trump into the mix here. And here, I think that the way we've been framing this debate, this challenge, is to think of it as good Trump versus bad Trump. And good Trump is lower taxes, deregulation, efficiency gains, improved sentiment, and all of that. Bad Trump, tariffs, immigration policies, and increased fiscal spending, let's say. Markets today, we think, are still in a little bit of a honeymoon phase where they are pricing in more of good Trump than bad Trump. So that's the first thing to kind of keep in mind. And also, when you think of how do these policies move the base case, we have to think of the timing of implementation of these measures, the sequence, and also the extent of implementation. How far is Trump going to go on trends on tariff or on immigration restrictions and so on? So while it's impossible to have a high conviction view on all three, timing, sequence, and extent, we need to have a base case view. And on our base case, if we have a measured implementation of the policy items on the agenda, uh, we think we can get away with a very modest negative impact on growth, but a slightly more pronounced impact on inflation. So it's modestly stagflationary, but nothing too worrying. The worrying outcome is if we have a full-throated implementation of most policy measures. Let me give you an example. If, for instance, Trump goes even 50% of the way in tariff threats on both China and the rest of the world, we think that would shave 1 percentage point of US growth and add 1.5 percentage points to the inflation, over the next couple of years, even if the dollar appreciates by 5%. So that's just to kind of give you a flavor of the stagflationary impulse of some of these policy measures. But it doesn't have to be all doom and gloom. We could have a measured implementation. We could have an implementation of the policy makes, which is calibrated in a way that it doesn't inflict too much damage on the economy. So we don't have to lurch to the worst case outcomes on these policy measures. We already saw a little bit of insight on that on Trump's threat against Canada and Mexico, and very quickly kind of following a phone call with President Sheinbaum, sounding a little bit more constructive. So already there is some evidence to this being more transactional rather than ideological. So we're not too worried about the worst case outcome, but sticking close to fundamentals and what the fundamental drivers are telling us.
Yeah, no, thank you for that. Yeah, it's very clear how kind of the moving parts to this and what to look out for once we get policy kind of starting to be announced. Can we maybe kind of whistle stop tour of the kind of global markets? Can we maybe move on to Europe? And clearly, one of the features of markets over recent years really has been that kind of divergence in economic performance.
Right.
And obviously, Europe is sensitive to a lot of the policy that's coming from the US. But could I ask you to maybe just talk through some of the considerations that you have with regards to the European region?
Right. The two things to keep in mind here. One is cyclical and the other is structural. So cyclically, more so than the exposure to China, which has hurt the German economy, for us, the biggest source of disappointment in Europe so far this year has been the reluctance of the European consumer in spending their excess savings. So they did not quite follow the same playbook as we saw in the States. So we saw precautionary savings going up. So there's definitely been a bit of a confidence crisis. So that was a big drag. We are seeing some very early signs of this turning around. Third quarter numbers on consumption weren't too shabby. So that's a space we're watching closely. Our economists seem a bit more optimistic that we see a bit of a cyclical turnaround in European consumption. So that's something to watch closely. The second aspect is more structural, and this is where I'm less constructive. Um, we think Europe remains both institutionally and politically too fragmented for it to come up with a coherent and convincing growth strategy. If you think of the biggest challenges, French fiscal consolidation is going to be an issue in the coming years. Um, you have German elections coming up early next year, which could result in a change of tack in terms of their policy priorities, but we are not holding our breath. So so there are structural considerations here. But in the near term, the way we are thinking of Europe is that it's torn between two outcomes, two almost, I wouldn't say tail risk, but not in the central base case. One is a demand shock from tariffs. That would, of course, be negative for the European economy. Another is a positive supply shock if we have a potential ceasefire in Ukraine, for instance. So those are the two scenarios to kind of keep in mind. It's hard to time each of these, but underlying this is an economy which still is challenged in a number of ways.
Still has a number of challenges. Yeah, no, thank you for that. And maybe let's finish off this kind of economic part of the conversation and talk about China. And you mentioned it in that very first question, but the stimulus package, that kind of pivot policy was another one of those kind of big stories of 2024. Can you give us a bit more detail, kind of how you interpreted that, kind of the challenges that China faces and the potential for success of that policy?
Yeah, absolutely. I mean, as you rightly said, it's the policy cycle which matters in China more than the economic cycle. So we have to make sure we're on the right side of the policy cycle. And the way we frame this is to think of it as three issues: intent, size, and follow through. Right. So let's start with intent. Is there intent to address cyclical weakness and growth? Absolutely. Because the most boring, sorry, the bearish take you could have had on China was to say that the leadership does not really care about short-term cyclical weakness as long as the medium to long-term priorities are still we're still making progress towards those. They might let growth slip further. So that could have been the most bearish take. We now know that that's not the case. We now know that the leadership is very keen in drawing a line under the sand, under the weakness of the economy. And so that's been made pretty explicit. And if there were any doubts left, we saw in the most recent Politburo meeting and the communique which came after that, it's something it is a priority for now. The second point is one of size. Are we satisfied with the size of stimulus? Definitely yes, on the monetary policy side. On the fiscal side, so far, it's been more rhetoric than action. But I think the risk is that we are too impatient here. And also, interestingly, the further away from China you get, investors are more disillusioned about the momentum of these policy measures. So I think we have to be realistic in how these measures are announced and implemented. And I think we can still look forward to early next year to see more concrete steps on the fiscal policy. And the third aspect of this is follow through. And I'm afraid it's too early for us to see tangible benefits from these policy measures yet. So the big picture is that we are in a policy upswing. We haven't been in a policy upswing for a very long time. Think back to deleveraging, think back to common prosperity, the focus on quality of growth rather than the pace of growth. So we have lived in that kind of a restrictive policy environment for quite a few years now, but we think we are turning a corner in that, at least in the short term, the leadership is pretty serious about addressing cyclical weakness and growth. I'm sorry, and the final point I need to mention here is we warn against thinking of China as a cheap market. China is trading on 10 to 11 times, and we think that's the fair value of the market. So, given all the issues with transparency, given the issues with some of the structural problems the economy is facing, and poor return to the shareholder, putting all of that together, we think fair value of the Chinese equity market is around 11 times. So the upside from here really is through earnings. So that's something we're looking at mostly.
Yeah, no, some really important points in there. Yeah, absolutely. I mean, maybe let's move on to the market itself, and perhaps let's start with the equity markets. I mean, you referenced earlier that markets have initially responded pretty positively to the election result in the US, but it is clear that valuations on aggregate are quite heightened, particularly in some concentrated areas. I just wondered, given the backdrop that you've just kind of laid out and where valuations are in certain areas, how are you kind of viewing the outlook for equity markets at the moment?
Yeah. See, risk assets have had a great run, right? So we've had two solid years of almost 20% returns for equities, and for good reason. Both macro and micro considerations have been very supportive, but it leaves us in a position today where we have very little margin for error. So we need to see the macro backdrop being quite benign for the time being for us to justify these kind of valuations. And let's take US equities for instance. One of the more frequent questions we get is whether we are already in a bubble. And to which we say, we think US equities are expensive, no two ways about it. But you have to think of how markets trade around fundamental valuation anchors. Um, in our view, the fair value multiple for US equities is 19 times. No change in view there, right? Currently, we are at 22 times. On 22 times, that represents an overshoot from our fair value anchor. But markets more often than not trade above fair value. They don't miraculously stop at fair value and go sideways. So there is often an overshoot in valuation as long as the macro backdrop is benign. And we think that is what we are seeing right now. What do we see to unravel that? The big risk, of course, is disinflation stalling, or even worse, reaccelerating. We are seeing some signs of disinflation, not quite progressing with the kind of momentum we would have expected it to. Or on the other end, you could have a classical growth scale. So in the absence of either of these two, we think US valuations can be supported at current levels. Another way to look at it is to look back at history and look at the major market peaks or typical bubbles. And these instances usually have three very clear telltale signs. First, there is euphoric sentiment across the board. Second, leverage tends to be quite extended. And thirdly, there is feverish activity on IPO and M&A. This is not the case today. So on our bubble indicators, we are 60% of the kind of froth we had back in the dot-com peak. So we push back against this notion that we are in a bubble. Yes, US exceptionalism is very well flagged. That's fair. But for us, that in itself is not reason to call time on a trade, which we think is still grounded in fundamentals. So our expectation for next year, we have a year-end S&P 500 target of 6,400. So essentially mid to high single-digit returns for equities. I don't think it should be sniffed at because we are coming after 2 years of very strong returns.
Yeah.
3 years of 20+ returns is unprecedented in history. So we need to take into consideration the starting point of valuations being quite challenging.
Yeah, no, absolutely. Some good points there. Maybe let's move on. So we kind of mentioned inflation as we've gone through this conversation, but kind of expectations for interest rates. And we've kind of perhaps slightly unfairly scheduled this in straight after a Fed rate decision yesterday. And the kind of dust hasn't perhaps settled quite after that, which kind of largely see as a bit more hawkish from the Fed. But
Yeah.
I mean, what are the key considerations there? You talked about that kind of risk of this inflation kind of stalling, but some of the key considerations you've got with regards to fixed income and credit markets for the coming year?
Yeah. I mean, see, the outlook we had laid out for the year in the fixed income space was one where easing is going to get less synchronized. We had said that you'd see a shift towards local dynamics becoming more important, and that this coordinated global easing we thought would come to an end mid next year, mid 2025, and specifically in the US. We were uncomfortable with market pricing. We had said that we are 2 to 3 cuts below where the market was. So in a way, we are more comfortable today after the Fed's decision, and excuse me, after hinting at perhaps they have to be a bit more hawkish. Also looking back at the progress on this inflation stalling a little bit. So all of that for us makes perfect sense, and we think that's, if anything, a healthy move. And the reason we say that it avoids the worst case outcome, because the worst case outcome is one where the Fed is on autopilot, keeps cutting, disinflation stalls, and then would have eased too much and would have had to reverse course at some point next year. So that would have been a terrible outcome for almost all asset classes. So with Fed somewhat, I wouldn't go as far as calling it a pivot, but it would be perhaps more catching up with reality. What it's done essentially is it has preserved a policy put or a Fed put for a little bit longer. So we think by and large it's a healthy development. The ECB, on the other hand, we think has still a lot of heavy lifting to do. We expect them to continue cutting sequentially till they reach 175 or they are given 1.5%. Um, we have a call that the SNB, the Swiss National Bank, if anything, has to cut into negative rates again, quite reluctantly, but they may have to do that. So, as you can see, there's already quite a bit of a dispersion in dynamics, and I think that would be one of the kind of themes for 2025. In terms of how we are positioned, we still struggle to see value in government bonds because despite higher yields you're seeing today, and that's because we still have inflation risk, fiscal risk, not just Trump's policies. So all of that we don't think has been adequately priced in. So we still are only neutral on government bonds. That said, we think the correlation with equities should turn classical going forward, so that improves their diversification benefit of a balanced portfolio. So from that aspect, we think bonds make sense. Um, but otherwise, we struggle to see pockets of value, especially in a soft to low landing kind of an outlook. Um, Final point on credit. See, if we take a medium term view, you can't ask for a better macro backdrop for credit as we have today. Um, Moderate growth, mild inflation, attractive income, and also a more dispersed sector exposure compared to equities in an environment where we think growth is going to broaden out. So all of that makes perfect sense. The problem is in the short term, you have to be cautious because spreads are extremely challenging.
No.
There are record tights, and to kind of give you a flavor for how wafer thin these margins are. You only need to see 15 to 20 basis points of margins of spreads widening in both US and European investment grade credit before government bonds start outperforming them. So the case for credit over bonds in the very short term isn't very strong from a valuation perspective. But there are still some areas we like. For instance, we like short duration European high yield bonds. So there are pockets of value, but by and large, we think we have to be cautious when it comes to credit and be selective. Which in fact reminds me, a point I didn't make on equities is that selection we think is going to be very key because we think we are going to be in a macro environment where growth kind of normalizes to trend. Central banks aren't going to do a great deal. Yes, there's going to be a little bit of calibration here and there. So the big mover for us is going to be more idiosyncratic, more industry dynamics than uh, overarching sector rotations or style rotations. And already something which we highlight to clients is what's often overlooked is even within a winning sector like tech, selection is key because if you strip out NVIDIA, tech as a global sector, or sorry, within the US, has not outperformed the market since 2020. And that for us is amazing. You could have been in tech, but if you had selection wrong, you'd have still underperformed the market. So selection is key, I think, going forward.
Yeah, no, really important point there. Yeah, thank you so much for that. I mean, I wonder with the time we've got left, whether I could kind of throw some quick fire questions at you, kind of talk through some of the areas we maybe haven't touched on. It's been a really good summary so far, but And let's maybe start with the risks, if I may, and just kind of if I was to ask you what the kind of most concerning risk or tail risk, what worries you most within markets at the moment, what would that be if there was kind of one that you'd pick out?
Inflation reaccelerating and 25 turning out to be a me 22.
Within your team and kind of the kind of views that you've got, if there was kind of one kind of least consensus view, we've talked about a number of factors which obviously being talked about kind of day to day within markets. But if there was one kind of one view that you had that you think you're kind of against the consensus, what would that be?
Um, one of the most consensus trades today is a higher dollar. We think we'll end
Okay,
25 with the dollar weaker than where we are today.
really. But based on what sort of factors would be driving that?
Essentially, some amount of normalization in growth in the second half of next year.
Okay.
And that's I don't think that is priced in.
Okay. Um, and again, hopefully this isn't the trickiest one, but if I was to push you to pick kind of one highest conviction area or kind of asset class or one particular strategy, what do you think looks maybe something that's got kind of valuation
Yeah,
attractions, but also fundamentals are strong?
yeah. I would say that would have to be US mid cap.
Okay.
Um, we like the Magnificent Seven, so we like the mega cap as well. So it's a bit of a barbell strategy for us, and then in the US we like both ends of the size spectrum. Not so much Russell 2000, but mid cap.
So yeah, certainly that kind of trend of a broadening out of returns. Yeah, we've heard that from a number of underlying portfolio managers as well. And maybe to finish off, if there was kind of one macro event or one kind of event that you're kind of looking out for in 2025 that you think is going to be particularly impactful, what are you kind of looking at there? What are there kind of certain things that you think will really impact markets next year?
I mean, see, hopefully, we don't think next year should be all about central banks,
Yeah.
but we would have to digest this divergence in monetary policy. We got a little bit of flavor for that yesterday, but till that becomes the consensus, we might see markets kind of be a little volatile. So I would say one of the macro themes for next year would be divergence in monetary policy.
Yeah, that's going to be fascinating to see that. Yeah, and I mean, I always think you've got one of the most challenging jobs trying to summarize so many different kind of moving parts of things. But that's been a really useful session. Thank you so much for your time today.
Thank you. It was a pleasure, and wish you and your listeners a Merry Christmas and a fantastic year ahead.
Yeah, and to you. Yeah, thank you. Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com. For more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co is authorised and regulated by the Financial Conduct Authority, the FCA.